In commodities, we've created something quietly dangerous, the manager of managers problem. But the good news is, it's unlikely to survive in 2026. Across the sector, the cleanup has already begun, even if many executives would prefer not to acknowledge it just yet. Over the last 12 months alone, the restructuring has been impossible to miss. Take Glencore, one of the largest, biggest and most successful commodity traders of all time, has removed roughly 1,000 roles under a global simplification plan. Rio Tinto also has imposed a 4% annual unit cost reduction right through to 2030. Newmont is also preparing for thousands of reductions following its acquisition activity. Petronas also is removing around 10% of its workforce. ADM, Cargill and others are collapsing regional structures that once sat behind half a dozen reporting lines. Even firms with newly appointed COOs already understand what's coming. A deep clean of structures that have simply outgrown their purpose. Not because people have failed, not because markets have collapsed, but because these organisations have accumulated more structure than the business could carry. It's a little like hoarding, but instead of old newspapers, it's a bunch of job titles. Over the past decade, the industry quietly built itself into paralysis. Managers of managers, heads of heads, COOs under more COOs. Divisional C-suites created largely to ensure someone could speak at length in meetings that produced very, very little. Even strategy offices, tasked to supervise other strategy offices, started appearing. These roles looked enormously impressive when margins were high, but the moment the P&L took a dive and went under pressure, ownership started dissolving. Even HR followed the same pattern, layer after layer, until HR itself had more hierarchy than the business units it was supporting. At one point, it generally felt like the HR department required their own HR department, and some days it still does. The outcome wasn't accidental though. We built top-heavy organisations where accountability disappeared somewhere between who reports to whom and who actually owns the outcome. Even consultancy research, including the Great McKinsey, shows that each individual layer slows decisions by roughly 25% and distorts information by around 30%. But commodity traders, we didn't avoid this. Many of us amplified it. For years, strong margins masked the problem. That era, though, is now over. The curve ahead of us looks nothing like the curve behind us, and the sector, quite simply, is too heavy for what is coming next. This is not just about cost, it's about making space. The firms that succeed in 2026 will be the ones that return to structural sanity, creating room for the talent the next phase actually requires. And I'm talking tech-aligned operators, digital asset specialists, AI engineers, model-driven schedulers, risk teams fluent in real-time on-chain liquidity. Whatever the next cycle brings, one reality is very clear. The era of the group global divisional regional head of managers of something that nobody knows about is over. The market has already been cutting, and it's doing it decisively. So anyone who believes commodity organisations can maintain their current weight hasn't been paying attention. Or they're still reading last decade's organisational chart. The market sees it, competitors see it, the financials certainly see it. The only people who don't are usually the ones with the longest job titles. Ornamental structure is no longer tolerated here anymore. The only open question is whether leadership simplifies by choice or is forced to react later. Now, if you're wondering how we arrived here, the explanation is not especially complicated. Between 2010 and 2022, cheap capital and strong margins rewarded complexity. Somewhere along the way, organisational size became confused with sophistication. Each new geography triggered a new regional COO. Each new product line earned its own divisional CFO. Then came weird job titles like transformation leads, trade flow chiefs, heads of excellence, or whatever that's supposed to mean. We built managers to manage managers who manage absolutely no one. Structure expanded faster than throughput. Even research confirms what insiders already know. Manager of manager roles rose by 30%. Decision speed fell, however, roughly by 25% per layer. Information accuracy declined by around 30% also. Even executives themselves later acknowledged that many of these roles inflated organisation reality without actually adding value. And then we have the ESG era. Remember that? Committees, task force, councils. None simplified absolutely anything, and all added hierarchy. Meetings about meetings, people circling back, people going forward. Meanwhile, in the real world, technology was quietly removing work at record speed. Automation expanded, CTRM systems upgraded, digital bills of lading arrived, API-driven reconciliation became an absolute standard. Yet instead of shrinking, organizations added oversight to oversee oversight. Work didn't increase, supervision increased. We didn't build leverage, we built drag. By the end of 2026, the winners and losers will be unmistakable. The next decade rewards clarity, not complexity. Winning firms will operate with radically simplified leadership, and there'll be 4 true owners: the CEO, the CFO, the COO, and the CRO. Everything else is just execution. We don't need co-COOs, no heads of heads, no deputies reporting to deputies, and no titles that take longer to say than the work itself. Capability will hopefully replace vanity. The only new heads that will matter in 2026 will be heads of AI, heads of digital asset, and heads of data. Because you cannot run a 2030 supply chain with a 2010 management structure anymore. Those days didn't fade away, they ended. They ended with the BlackBerry. What replaces them, however, is something simpler and sharper. Lean global capability centers, repeatable work consolidated into hubs, trading teams kept lean, fast, and close to the markets. Technology will become the operating system. Schedulers run models before moving molecules, and risk teams will see liquidity in real time. COOs will talk automation, not headcount, and CFOs should treat data with the same discipline as cash flow. Winning firms won't add layers, they'll add intelligence. So the structure you carry into 2026 will decide whether you compound advantage quietly or bleed it. The greatest threat right now to commodity trading isn't volatility, it's internal friction. A decade of inflated titles, redundant layers, committee-heavy governance, and sprawling manager-of-manager structures has created drag no market cycle can disguise. But this isn't a phase. It isn't a trend. It's a reckoning. Some firms will act early by choice. Others will be forced by margins. But the rule of the universe is simple. The firms that survive the next era will be the ones willing to redesign themselves without nostalgia, without excuses, and without carrying a single layer more than the work generally requires.